This week we're doing our last week on double entry accounting, and what we'll be looking at today is we're going to recap what we did last week briefly, and then we're going to look at how we want to know results for a period. We don't want to wait for the lifetime of our business, and as a result of that, that's why we have accrual accounting. And we'll be looking at balance day adjustments, where we are looking to get the expenses and revenue in the right period. And also we'll be looking at how we do some other balance day adjustments, particularly around accounts receivable. Then we'll see that once we've done that for a period, we then need to get the accounts ready for the next period. And then we'll see that we close off the temporary accounts. And one of the key takeouts from today is that revenue and expenses are temporary. They're just there for the year. And we'll see the reversing entries. And we'll see that accrual accounting in a large part in our firm's accounts is just for one day. A lot of it is just there on balance day. We'll then do a minute paper and a summary. So what did we look at last week? Well, we looked at the use of specialised journals, and we saw that specialised journals replace the general journal to the extent we use them, particularly around sales, purchases and cash. We also had a look at general journal entries, and we saw that with those entries we need to put in narrations or descriptions to give a bit of background, and that applies to the computerised systems as well. We looked at subsidiary ledgers, and we see that they don't replace the general ledger, but provide further detail on different items. And then we looked at bank reconciliations. That helps us keep track of cash, and we saw that with the growth in direct bank feeds now, which have gone into the SMEs as well as large companies, we're able to do our bank reconciliations on the run. So every day or multiple times a day, and keep our accounts live. Bank reconciliations is where we check the bank account with the bank and with our accounts and make sure they're in sync. We also looked at depreciation, which is an important item with non-current assets. And that's where we estimate how much of our non-current assets we used up, how much of their economic value we used up during the period to earn the profit. We'll be looking at that in much more detail later in the term. So that's what we looked at last week. Now this week we're going to have a look at our desire to know results for a period. And we want to know the financial position at a point of time and also the financial performance over a period. And it's our desire to want to know this. We don't want to just let businesses run, that we have our balance day adjustments. We need to make various adjustments so that we can measure the performance in a period and get the financial position at a point of time. And so on a day-to-day basis, a lot of our accounts are kept on a cash basis. The accruals aren't there. And so we need to put a lot of the accruals in on balance day. And then we'll see the next day we take a lot of them out. So we put them in for a day and take them out for a day. So the accounts that we see for each of our businesses on the balance date are quite different to what they're like on the other days. And we're going to see how that works in terms of the accounts put together. And just remind you that the reason we're looking at bookkeeping is so that we can understand where the accounts come from and the bookkeeping that goes on. Even though a lot of it's automated now, we need to understand that in order to be able to interpret and understand accounts. So one of the themes today is accrual accounting just for a day. So one of the things we do is we want to get the accounts ready for the next year. And so we're going to have the balance statements, then get them ready for the next year. And there's some general journal entries that we'll be looking at. The revenue and expense account balances we'll be transferring to the profit and loss account. They're temporary accounts, revenue and expenses, unlike assets and liabilities. And then we'll be transferring the profit and loss account to the capital account. And for companies, that will be to retained earnings. And we've all got companies as ours. And then the ledger accounts, there'll be transfers between the firm And the equity investors, for those that have occurred during the period, such as dividends, might be some share buybacks, share issues, they'll all also be transferred to the capital account. So we've got the balance day adjustments, then we get the accounts ready for the next year to kick off. And you can see when we start the year, revenue and expenses, for example, have zero balances. Now, a lot of this is done automatically nowadays, so you sort of press the button, you sort of do a lot of this stuff. But what we'll be doing is lifting the lid on what's happening and see what's happening inside. So that's what we're doing today. So balance day adjustments. One type of balance day adjustment is to correct errors. To err is human, to forgive divine. Alexander Pope. The people are involved with accounts, so there's going to be errors. We all make errors every day, all the time. So what happens in balance date, that we can correct errors at any time, and we do, but when we find them. But at the balance date, we have a bit of a look at our accounts, and we can often find some errors there, and so we correct them. So one type of error is we can put items into the wrong accounts. So what we do initially in accounting is we have a transaction of some sort, we analyse it and say which accounts does it affect. And we could get that wrong. In this example, when we look at the accounts, we see that the telephone and internet expense is a lot higher than we sort of were thinking. And Chris, who owns Coffee Supreme, you can imagine he sort of might look at that and say, man, that looks like a big, or the accountants say, that looks like a big item. And what happened here was that it was incorrectly analysed. There was some website maintenance expenses. If you look at the Coffee Supreme website, they've got this great website, probably cost them a fortune to maintain it, keep it up. And it had misapplied, somebody had put it into telephone and internet expenses by mistake. So one balance day adjustment is to correct that. And so you can see here, $23,000 was incorrectly put into telephone and internet expense. So to correct that, what we do is we debit the expense. We increase the website maintenance expense by $23,000 because it should have been in there, and we take it out, which means crediting the telephone and internet expense. And you see it's in the general journal, and there's a little note, correcting previous incorrect entry of website maintenance expenses, telephone and internet expense. So put a little description there because otherwise you wouldn't know what this entry was. You'll also note that in this entry there's no changes to the GST accounts. Because it was just in the wrong account, the GST side of things is unaffected. So that's one type of balance day adjustment, is where we correct errors. But of course we can do that at any time. A number of people have discovered that their accounts, say their 2015 accounts, some of the items might be slightly different to the 2015 items, some of them in the 2016 accounts. A few people are discovering that, firms. That's because after balance date, you can keep correcting errors, obviously, as they occur. As long as they're only little, it's not a problem. And so you're constantly looking for errors and correcting them. But balance date is a day where you can particularly tidy up and notice some of these. The other thing we want to do is get the expenses into the right period. One of those is accruing expenses that have been incurred. The economic substance of them has occurred, but they're not in our accounts yet at balance date. They may not be in our accounts because we haven't received an invoice or we haven't paid for it yet. And the example I've got here is salaries. Salaries expense, staff salaries. Typically, we pay staff in arrears. They work quite often 2 weeks, might work for 2 weeks, and then we pay them. So say that 2-week period overlaps the balance date, we need to adjust for that. And we'll look at that in detail in a minute. Now, the fact that we pay something like salaries or other expenses in arrears, so the cash and the expenses goes into our accounts here, but it's incurred, over a couple of weeks before that, over that period. That doesn't matter. Obviously, that'll all wash out as we go along, but it does matter if we want to measure a performance for a period. and the financial position at a point of time if that sort of overlaps the balance date. The reason for that is that profit equals revenue less expenses. So if our expenses, in this case salaries, some of our salaries expense are not included in the period because we're not going to pay for them till a week or so later, then our profit will be overstated if our expenses are understated. So that's why we do that on balance date. So 31st of March 2018, this is Coffee Supreme's balance date. We get to that, and we know that we pay salaries every fortnight, so we know we're going to have to accrue some salary expenses. So we've got salaries, expenses, and accrued salaries. And in this example, we pay, the last pay we gave was on the 24th of March, and so the next one is on the 7th of April. So we've got 1 week of salaries that we've incurred. The economic substance of that expense has occurred. People have turned up and hopefully they've done some work, and we need to get those expenses into the period, salaries expense, for 7 days. So to do that, we've got to increase the salaries expense. That's a debit. In this case, $26,412.53 is those 7 days worth of salaries. And then we credit accrued salaries. This is an increase in liability, $26,412.53. Increase in an expense is a debit. If you don't know that now, you need to go and do the 3 things to memorise. All you have to do is write it down 40 times. You can do it in a day, over a period. I'll stop talking about that soon, but you will need it in this unit, you will need it, and you'll need it through your accounting degree. You need to be able to do your debits and credits, because we'll be looking at the accounting treatments in increasing complexity through the degree, and it'll be assumed that you know all that stuff. You get it in this unit. So those 3 things to memorise are essential. And then you'll know we're going to increase the expense, so it's a debit. And we're going to increase the liability, and it's a liability because a liability is an obligation today to forego some economic benefit in the future, which is cash. We're going to have to pay for those 7 days of salary in a week's time. So that's a liability. Increase in liability is a credit. Increase in expense is a debit. So you've got to be able to, you've got to know the 5 elements of accounting and their definitions. You've got to be able to recognise items, how they fit into those 5 elements, and you've got to know those 3 things to memorise so you know where the debits and credits go. So that's getting expenses into the period that aren't there. In this case, a salaries expense. We've increased a liability. The other thing that happens is that we pay expenses early. This is for quite a lot of expenses. I've taken insurance as an example. Quite common for us to pay insurance in advance. In this case, I've assumed we pay it a year in advance. And so the insurance company gets all our money, up front. But we get the benefit of the insurance over a period. So we've got too much of this expense in this period, so we've got to get some of it out. So we've got the insurance expense and we've got a prepaid expense. So to the extent we're paid for insurance that covers the period after the 31st of March, we've got to take it out. Now the prepaid expense is an asset. It's the expected future economic benefit of gaining insurance company in the future without having to pay for it in the future. So we're going to get a future economic benefit of this insurance without having to pay any more money for it. So we increase that asset, that's a debit, $64,504.12 in this example, and we reduce the insurance expense, $64,502. Reduce the expense, that's a credit. That's an increase in expense as a debit, a reduction is a credit. So you can see in some cases where, in this case, we're taking out some of the insurance expense out of this period because we prepaid it. and we're creating an asset that will be sitting there just for the day on balance date. And the amount of that is the amount of insurance that we had paid that covers the period after balance date. So we have to do that with expenses. We have to put some in and take some out for the period. And we need to do the same for revenue. We need to get the revenue in the right period. So in this example with Coffee Supreme, I've assumed they've got some money with Westpac in a 6-month term deposit, and it matures on the 30th of June 2018. Their balance date is 31st of March. So in the next year, they're going to get the interest. That's $10,000. That'll get paid at the end of the 6 months. And so the interest that they actually earn, the economic substance, the interest earned in the 3 months, the 31st of March, is half of that. So half of $10,000, $5,000. So they've actually earned some revenue, interest revenue, $5,000 during the period, but they're not getting paid for it until the next period. So on balance date, the 31st of March, we're going to accrue that interest income. And so what we're going to do is that we'll recognise an asset, an expected future economic benefit. We expect to be paid this interest in cash in the future that relates to the last 3 months, where we've actually earned the interest but not been paid it yet. That's $5,000. And we'll also recognise an increase in revenue, interest income. That's a debit. That's a credit, so I should say. The debit is the increase in the asset. Increasing the revenue is a credit, $5,000. Accrual of interest earned on the term deposit with Westpac with maturity date of 30 June 2018. The description of it. So here we've brought in some income that we've accrued some income into the period. Again, you need to know the 3 things to memorise. It's not optional. It only takes a few minutes. You need to do it. But I can't force you. Then we also receive revenue early. We can, Coffee Supreme, in their head office, it's in Hopper Street in Wellington. And remember when Chris built it quite a few years ago, and it's a great little setup. But there's a coffee shop in the building, in the street, called Hopper Street Cafe, and they rent that out to people who run it. So they've got a tenant. The tenant pays their rent. Quite typically, people pay rent in advance. So I've assumed that they pay $995 monthly rental in March for the April month. So they paid in March 2018 for the April month. So Coffee Supreme has received this rental income in advance, but they won't earn it until after balance date. So we reduce the rental income. So we take out that $995. So we debit rental income. That reduces the revenue. And we credit the increase. We credit unearned rental income, which is a liability. Why is unearned rental income a liability? Well, we have an obligation today to provide that coffee shop space to the tenants of the Hopper Street Cafe in April. And they don't need to pay us anything for it because they already have. So we've got to forego some economic benefit, giving them the coffee shop to use for a month without having to pay us any cash in the future. So rental income received in advance being rent for the Hopper Street coffee shop for April 2018. So we've reduced the revenue in that period. So in terms of expenses and revenues, we've accrued some expenses and, in other words, we've brought in some expenses, accrued them into the period, and we've also had recognised some prepaid expenses that we've paid in advance, which we've taken out. And the same with revenue. We've accrued some revenue that it wasn't in our accounts but should be, the economic substance, and then we've taken out some revenue that's in there that's not earned yet. So we had a look at some journal entries around that. Obviously, they're often in specialised journals. We've just looked at them in a reasonably simple way. And the key thing to remember about these is that they're done on the last, these balance day adjustments are on the last day of the accounting period. So in this case, 31st of March 2018. And they are in fact there just for one day, the day of our accounts. Ryman Healthcare also has a 31st of March balance date, so there's a whole lot of items in there that are only there that day. And the same for West Farmers, their balance date's 30th of June. So we've got these various balance day adjustments. We've looked at revenue and expense ones. We saw that there's correcting errors that goes on. They stay there, of course. They don't get taken out. The expenses and revenue, putting them in the right period, which are there just for the day. And also, we take the opportunity on balance date to have a look at certain items and just assess their reasonableness. And for example, accounts receivable would be one of those. We can look at them at any time, of course, but on balance date is definitely a good time to review that, at least on that day. And what that is, it's what a firm expects on balance date, in this case accounts receivable, to be able to reasonably collect from its customers that owe its money, so its debtors. So have a look at that. Because the reality is when you sell on credit, some people won't pay you. And there'll be, a few people who won't actually pay you. So in this case, I've assumed the Abbotsford Club. This actually is a Coffee Supreme actually own this cafe themselves, but I've just assumed it's owned by somebody else. It's down in east of Melbourne CBD, near the Yarra. I think I've got the right one. And I'm just assuming it's gone bust. The owners of, coffee shops do come and go a little bit. Some people seem to be able to run them better than others, and people running Abbotsford Coffee Club just couldn't hack it. They didn't. Very bad coffee, poor service, whatever it was, they didn't make it. And they're not paying you the debt. And so, not good outcome, but you decide that these people aren't going to pay us. So you recognise a bad debts expense. In this case, $927.27. And the GST paid and the accounts receivable control. So we debit the bad debts expense because that's an increase in an expense, debit. We also debit GST paid. That's an increase, that's a decrease in a liability, I should say decrease. That's a decrease in liability because we don't need to pay, we haven't actually got that GST paid, that they're not going to pay us, so we don't need to pay the government that GST paid that we've already recognised. And we credit the asset accounts receivable because we're reducing the asset. Increase in assets are debit, reductions are credit. And we also do that with the we'll get to that in a minute. Now you can see that the bad debts expense is GST exclusive. We know that. We looked at GST a couple of weeks ago. As a general rule, the revenue expenses in the income statement, they're GST exclusive. Also the items in the balance sheet, GST exclusive, except for a couple of exceptions, one of which is accounts receivable, accounts payable. GST inclusive. So we deal with GST when we're doing it on the bad debts expense, and we reduce the GST paid. But on the other side, we don't need to worry about GST because it's GST inclusive. So don't have to do that separately. And the credit, the general ledger and the subsidiary ledger. So you can see that where we've got subsidiary ledgers, typically with accounts receivable we credit both the control account and also the subsidiary ledger. But subsidiary ledgers don't replace the general ledger. They simply give more detail. So that's what we do with bad debts. Bad debts are very sad in business, but they do happen all the time. Also doubtful debts. When we come and we look at our accounts receivable, we can take on balance date a general estimate. We can generally estimate the allowance for doubtful debts. It's usually based on past experience. Also, we can look at the age of the debtors and so forth. Bad debts are specific. They're identified amounts owed by specific identified customers. Doubtful debts is a general estimate. We don't know who's not going to pay us, but we just know based on past experience, maybe it's a couple of percent aren't going to pay us. If we knew who they were, we wouldn't have sold them the stuff in the first place. So, doubtful debts expense. In this case, I said we'll increase doubtful debts expense by $23,000. So we've looked at everything, and so what we've said is there's a $1.15 million, say, of extra accounts receivable or whatever amount. We've said 2% of that we think could be doubtful as a general estimate, so $23,000, and we've increased the provision for doubtful debts by $23,000. So we've debited doubtful debts expense because we're increasing the expense, and we've credited the provision for doubtful debts. And we'll be looking at liabilities and provisions later on in the term. So we can have a look at our accounts receivable, for example, do some entries for that for bad debts or doubtful debts. And so we can get our accounts in shape for the end of the period. And that's what we're going to see. But of course, the next step is we need to get ready for the next period. And once we've finalised our financial statements, we then need to do some closing entries to get everything ready to start from scratch to go forward. Key takeout from today, is that revenue and expense accounts are temporary. You see, the assets, liabilities, and equity keep going on. They're permanent accounts. We don't do anything to them. They just sort of roll along. But revenue expenses, we empty them out at the end of the period. They start each period at zero. So we call it closing off. That just means making them zero. And so the first day of the next period, our revenue expense accounts are zero. And the other takeout is a lot of the accruals are just for one day in our accounts. So how do we do this? Well, for revenue, let's just say these are the revenue items of Coffee Supreme. Coffee sales revenue, 8.4 mil. Coffee Supreme's revenues are a lot higher than that. It's a private company, but the amount of coffee they sell is extraordinary. Interest income, $25,000. Rental income, $11,940. I'm just making these numbers up. Add them all up and transfer. So you debit those revenue items because we're reducing them to zero. So that's their balances. We've taken it all out. And we put it all into profit and loss. We're crediting profit and loss. So that's the first step we do. Close off all the revenue. Then we do the same to expenses. We empty out all the expense accounts. I've sort of made up some numbers here. Salaries, insurance, interest, and so forth. And we empty them, all those expenses out to zero. That means we credit them because an increase in expense is a debit. So we credit them, and then we debit the profit and loss account. So we've credited the profit and loss account with all the revenue and debited it with all the expenses. So we've got all the revenue and expenses counts down to zero. And then there's a net balance, all the revenue less all the expenses. It's now sitting in the profit and loss account. In this case, it's $7,394,000 and so forth. And then we take it out of the profit and loss account. It's a credit balance currently, so we debit it and we put it into retained earnings if it's a company, which all of our companies are. And we credit that retained earnings. That's part of our equity. So all the revenue expenses gone through profit and loss. We've got a profit and loss figure, and it's gone to retained earnings. We also looked at the difference between revenue and income when we looked at the definitions and when we reviewed them in week 1. And we saw that income is defined in the, it's defined slightly differently to revenue. And revenue is in the ordinary course of activities, and income can include some gains that are not in the ordinary course of activities. We can also, and also revenue needs to be gross, but income can be net. So you can see that we've got some of these other comprehensive income items. We've got these other income items often in our accounts, and they also will get transferred often to some sort of reserve account and so forth. That's a little bit outside the scope of what we're looking at today. So what we can see is we close off or remove all the revenue and expense amounts, but we also close off or remove temporary asset and liability accounts that many of them that we set up as balance day adjustments at the end of the previous accounting period. You'll see that previously we set up various liabilities and asset accounts on the balance date. So they're in there in our accounts when we see them on the balance date, but they weren't there the day before, and they won't be there the first day of the next period. We'll take them out. The first day of the new accounting period, we take them out. So many accruals only exist on balance day. So generally, no accrued revenue and accrued expense accounts or accrued asset and accrued liability accounts, that we looked at previously, are there except on balance day. We put them in as balance day adjustments, and then we reverse them the next day. And so they're sitting in our financial statements so that we can see the results for a period and the financial position for a period. So let's have a little look at this. We've got accrued salaries. Remember that we said we paid our salaries every 2 weeks in arrears. So when we got to the balance date, we assumed that there was a week's worth of salaries that we'd incurred but not paid. So we had to get that salaries expense into the previous period. So so that's what we did. Accruing salaries expense for 7 days, and that's what we did. So what we do is we just do the reverse. So we'd increase the salaries expense on the balance date. Now we take it back out again. So the $26,412 that we increase the salaries expense, we now reduce it. Reducing the expense is a credit. And the accrued salaries we take out, back to zero. The $26,412.53. So that's reversing the accrued salaries at 31st of March. And so then what will happen is we'll then pay the salaries and so forth at the end of the period, in a week and so forth. And it'll all wash out. So that's one example of reversing entry. And so basically we'll do that with all our accrued assets and liabilities. So you can sort of picture what goes on as a cycle. Many ways of expressing this, but this is what I've got in the materials. We have financial transactions and economic events. They're occurring all the time. Constant avalanche of them in business. We need to analyse them. We need to say, well, wait a second, where does that fit into our accounts? What asset, liability, revenue, expense, and so forth does it go? And we put them into the journals. They're then transferred to the general and subsidiary ledgers. Journals can be specialised as well. Into the general and the subsidiary ledgers. They then go at the end of a period to a trial balance, and that can pick up some errors. There's human errors in here. Quite a lot of the errors they won't pick up. But if your trial balance doesn't balance, you've got some errors there. But if it does balance, that doesn't mean you've got it right. There could be lots of errors. Probably there are in a big company. We do not do double entry accounting the why we do double entry accounting is not to check the data entry. That is not the reason we do double entry accounting. It is a benefit, you know, we can use the fact we do it to sort of check. But you can see the error that we had, that I showed, that we corrected, where we put an expense into the wrong account. We put it into telephone expense instead of website maintenance. Trial balance won't pick that up, you know. But or if we've got, you know, there's a whole raft of errors that wouldn't pick up. So we don't do double entry accounting to check the balance. That's just a common sense misconception that people just think, oh, yeah, there you go. The reason we do double entry accounting is because of the view of business that we have, which is the owners and the business itself are separate. And everything a firm does affects both the owner and the business itself. A number of people are getting the idea of that. That's why we have all this complex double entry accounting. And the issue with that in going forward is that as businesses get bigger and bigger, particularly large multinationals that are bigger than many countries, they're affecting, even local businesses, they're affecting more than themselves and their owners. They're affecting their staff, they're affecting the environment, they're affecting the community, they're affecting the government, you know, and all sorts of people have an interest in them. And accounting allows nothing of that. All we look at is the effect on itself and its owners. That's what it can. So that's the challenge for accounting going forward, is how to adapt to the changing environment. And no one's really figured out how to do that yet. But a certain amount of the accounting research that goes on is focused on that issue in various ways. And you'll certainly see some of the ways that that's being dealt with as you study accounting further. But what we're looking at here is where the accounts come from and the underlying whys and assumptions. So you do the trial balance, then you do the balance day adjustments. I put including depreciation. We'll be looking at depreciation in a few weeks. And that's what we've looked at today. The balance day adjustments just on the last day. And particularly around revenue expenses we've looked at, but others as well. Then you come up with an adjusted trial balance. So you do all these changes, these new extra journal entries, and then you do the balance that's adjusted with all these balance day adjustments. From that adjusted trial balance is where you do the financial statement, where you put the financial statements. The division between bookkeeping and accounting is sort of traditionally anyway been the bookkeepers produce the trial balance, and then the accountants take it and develop the financial statements. But of course, everything's changing so fast that, you know, it's all a lot of the bookkeeping is becoming automated. A lot of those tasks are gone, and but we need to understand what's going on under the lid. Otherwise, we can't interpret the accounts that we've got. So from the adjusted trial balance, we do the financial statements. We know there are 4 financial statements that are required. The balance sheet, the income statement, the statement of change in equity, and the cash flow statement. We'll be spending a week on the cash flow statement later in the term. I think week 11. So you've got the financial statements, you prepared them, then you do the closing entries. That's where we get rid of all the revenue expenses and so forth. We reverse out and you know, we close off various accounts, and then we reverse quite a lot of the balance day adjustments, and then it's all back as if on the first day we're back to the whole process again. And so you can sort of visualize it like that. Okay. What I'd like to do now is go to the minute paper. We've got and answer these 2 questions. The minute paper's in Moodle. What was the most important thing you learned today? And secondly, what questions still remain unanswered?